reason, I do want to start by stating my intentions for this presentation very clearly. First and foremost, my goal is not to have you start buying Bitcoin in order to pump my bags. Unless there's a whale listening in, it's not going to have much impact on the price of Bitcoin, much less my own personal holdings of Bitcoin. I believe that you should put time into Bitcoin before you put money into Bitcoin, which is why you are here today. I am here today because I believe for the first time in human history, we have perfect engineered money. Money that's immutable, decentralized, and censorship resistant. And the impact on our world is and will be profoundly transformational. As someone who loves financial education, I personally can't help myself from wanting to help others gain a better understanding of what I believe is coming. You already met me. All right, so I am a partner at GBQ and I focus on construction and real estate. So what makes me qualified to present on this topic? First off, I know it's not MIT or Stanford or Harvard, but I did get a dual major in economics of finance and accounting from Olivet Nazarene University, about an hour south of Chicago, Illinois. Second, if you ask my wife, I'm an absolute loser, and for the past 4 years, I've spent approximately 90% of my free time, when I'm not with my family, listening to podcasts or reading books on this topic. This is a current picture of my nightstand, which again, my wife doesn't love, which includes some of my top book recommendations. The top one, The Bitcoin Standard, is the one that started me on my journey. The Big Print is the one that I read most recently, highly recommend. And then Broken Money is also one of my top books. So if you're interested in this topic, I highly recommend the next step is you grab one of those. This presentation is for entertainment purposes only. I'm not giving investment advice. Please do your own research, make your own investment choices. I'm not a registered investment advisor. I'm a CPA. These are my views and not necessarily GBQ's. So since we have that out of the way, what are we going to be talking about today? Well, as promised, we're going to talk about the basics of Bitcoin. We're going to talk about mining. We're going to talk about blockchain, all these words that you hear and you never really actually understand what they are. But before we get there, I do want to cover some of the current events, some of the news, what's going on in the economy, what's the history of money, so that you have a better understanding of what the problem is that Bitcoin is trying to correct. Now, again, as I mentioned, it's normal if you come into this presentation with a lot of skepticism. I wrote it off multiple times before I started taking it seriously, thanks to friends like Wade Foley and Brad Denzel, if you're listening. It's extremely hard to reason someone out of something that they were never reasoned into to begin with. And if you were born after 1971, when we went off the gold standard, which we'll talk about, all you know is our current monetary system. And even if you were born in 1960, you would have only been 11 years old at that point. Everyone is against Bitcoin until they are for it. It's an ego test. At some point, you have to be willing to admit that you didn't do the work and that maybe you were wrong. If you look at the Bitcoin journey here on this slide, I credit Michael Saylor for this. He's the chairman and CEO of MicroStrategy, which we'll talk about briefly. This is the Bitcoin journey. You're born a denier. It takes 1 hour of study to become a skeptic, 10 hours to become a trader, 100 hours to become an investor, and 1,000 hours to become a maximalist, and you believe it's a moral imperative to be spreading the word about Bitcoin. So I'm going to try and get you to an investor in the next 60 minutes. We'll see how that goes. It's estimated that you're going to spend about 60 to 80,000 hours of your life working to make money, maybe even more of that if you're in accounting and finance. I'm inviting you to spend the next hour learning how to keep it, and I appreciate you being here today. This is a list of common reasons that individuals are skeptical about Bitcoin. These were reasons that I was initially skeptical about Bitcoin, and there are obviously more. The only use case is nefarious. Jamie Dimon, Chase Bank is famous for that one. The intrinsic value is zero. It's not backed by anything. It's a tulip bubble. Warren Buffett is famous for that. Governments are going to ban it. It's too volatile. It's going to be hacked. Quantum computing. So my buddy Greg Hopkins asked a great question about quantum computing when he registered for this. Unfortunately, I don't have time to go through it in detail. Maybe my next webinar will be to go through some of these. If there's interest, it's going to be obsolescence or it wastes energy. So again, all great questions that you need to spend time learning and understanding. couple months ago, Bank of America issued a report on technological disruption over the past 1,000 years. And they listed Bitcoin on par with the printing press, the light bulb, the man on the moon, and the World Wide Web, among others like quantum computing and AI. Speaking of the World Wide Web, Bitcoin's adoption curve can be compared to the internet in the late 1990s and the early 2000s. Now, who on this webinar can remember how hard the internet was to understand back then? Quick video for you.
I wasn't prepared to translate that as I was doing that little tease.
Oh, that's
that little
right.
mark with the A and then the ring around it.
At?
See, that's what I said. Kay said she thought it was about.
Yeah. Oh.
But I'd never heard
Or
it.
around
I'd never
or-
heard it
okay.
said. I'd always
That's
seen
right.
the mark, but never heard
Yeah.
it said. And then it sounded stupid when I said it. Violence at NBC.
Yeah, I heard you around
big
or
fight
about.
in the lunchroom the
See,
other week.
there it is. Violence at NBC. GE.com. I mean,
Well, Allison should know.
what
do you
is
say to that,
internet
Allison?
anyway?
Internet is that
Massive computer
right,
network.
the one that's becoming really big now.
What do you mean? That's big. Wait, how does one? What do you write to it like mail?
No, a lot of people use it and communicate with, I guess they can communicate with NBC writers and producers. Allison, can you explain what internet is?
No, she can't say anything in 10 seconds or less.
All right. Bear with me while it goes to the next slide. Okay. Recent news and activity. This is a price chart as of yesterday. I just pulled up the price as of this exact moment, and it's slightly above this at 112,700. Bitcoin did just recently retrace from its all-time high of about 124,000 a week or a week and a half ago, down to 112,000. Now, if you think that 9 to 10% drop was going to scare me off, I gave my first Bitcoin presentation back in 2022 after the collapse of FTX. If you remember, that was a cryptocurrency exchange that was offshore. Sam Bankman-Fried is still in jail for that. The price went from 69,000 down to 16,000 a week before I had the privilege of standing up in front of everybody and presenting. So I've seen much worse. There is $1 trillion of global wealth in the world, and Bitcoin's current market cap, if you can see that tiny little square in the top left, is about $2 trillion. Art, cars, and collectibles are 27 trillion, gold is 22 trillion, equities are 135 trillion, real estate is 370 trillion, bonds are 308 trillion, and cash and money markets are 129 trillion. The important thing to realize here is that everyone on the planet is looking for the best place to be able to store their wealth. And Bitcoin's total addressable market is enormous. It's still very, very early. Bitcoin recently passed Amazon, and since it just fell back down to 112,000, it's now below Amazon, but it passed all these other assets and the largest assets in the world by market cap, moving up behind Apple, Microsoft, Nvidia, and gold. And you can see what price Bitcoin would have to get to flip the other assets in the world. Now, why is everyone looking for a place to store their wealth? This chart shows the purchasing power of the US dollar since 1913, which just so happens to be when the Federal Reserve was created. Now, this is why a majority of investors, smart investors, do not keep long-term wealth in cash. And for the most part, that's by design. The US closely follows Keynesian economics, which was named after Britain economist John Maynard Keynes. And the general theory is that if you believe your money is going to be worth less tomorrow than it is today, you're going to be incentivized to spend or invest that money, which, again, in theory, drives economic growth. The hard part is controlling that 2 to 3% arbitrary inflation target that has been set, which actually just last week in Jackson Hole, Jerome Powell, Fed chair, actually removed that benchmark. This is Bitcoin's current ownership distribution, and I do want to give a shout out to River. If you see River, this slide came from them. River is a Bitcoin-only exchange that is based out of Columbus, Ohio, and it's one of the largest exchanges in the world. I have personally met their CEO and their founder, great people, and they give a lot of really great resources. So if you do at some point decide to buy Bitcoin, I highly recommend River as an exchange. Of the total 21 million, and this is important, there will only ever be 21 million Bitcoin. It's the only asset that has a fixed supply. 68% is held by individuals, 5% is held by businesses, 6% by funds and exchange-traded funds, 1% by governments, 5% by Satoshi, the founder, which we'll talk about later, 1% other, 7% has been lost, so that's just supply that's gone, and only 5% of the 21 million Bitcoin remain to be mined, which again, we'll talk about what mining is, I promise. What's important to note here is that Bitcoin was not first released to Wall Street. Goldman Sachs, Wells Fargo, they didn't get a hold of it and then release it to everybody else. Bitcoin was released to the individuals, and now Wall Street institutions and governments are starting to get involved. It's also important to note that the founder of Bitcoin, Satoshi, only holds 4.6% of the total supply. They didn't pre-mine a bunch of Bitcoin, keep it for themselves, and then distribute it to everyone else. And all of those Bitcoins that he did mine in the first year have never been spent or moved. All right, we've got our first CP code word if you're trying to get CP today, and it is Satoshi. Give you 15, 20 seconds here to vote. Oh man, we've got one that said Bitcoin. Okay, moving on. So, best performing assets the last 14 years. As you can see, the top is the best performing asset, the bottom is the worst. Over the past 14 years, Bitcoin was the best performing asset in 11 of those years. However, you are correct, Bitcoin is volatile. For 3 years that it wasn't the best performing asset, it was the worst performing asset. Remember I talked about 2022 FTX collapse? That year, Bitcoin's price was down 63%. So I don't think it's any secret that Bitcoin as a nascent technology has been very volatile, but a lot of that can be managed through position sizing. On the next slide here, you can see inflation adjusted returns since 2020, when there's been a lot of currency debasement with COVID. A allocation of just 3% of Bitcoin would have preserved the purchasing power of the US dollar compared to holding it in a bank account or a money market fund. Now, obviously, past results are not a guarantee of future returns, but at what point will financial advisors take notice? Well, BlackRock is now recommending up to 2% for interested investors. That's the largest asset manager in the world. Morgan Stanley is unleashing it for their wealth advisors to start pitching Bitcoin ETFs. And just recently, the Digital Assets Council of Financial Professionals, which was founded by very popular RIA, Registered Investment Advisor, Rick Edelman, put out a white paper titled The Death of the 60-40 Portfolio, Why Your Crypto Allocation Should Be 10 to 40%. And he's getting, obviously, a lot of commentary on that in the news. What is the summary of that report that he put out? I'll just read some of the highlights here. This traditional 60-40 stock to bond allocation model is dead. Conservative investors should now have a 10% crypto allocation. Moderate clients should place 25% of their portfolios in crypto, and aggressive clients should allocate 40% of their investments to crypto. Owning crypto is no longer a speculative position. Failing to do so is. There's no logic to admitting an asset class that's outperformed all others for 15 consecutive years. The real question, are you a fiduciary serving your client's best interests, or are you simply an order taker avoiding difficult conversations? Okay, so obviously there's a lot of education that has to happen, and even once it happens, there could be financial advisors that disagree, and that's fine. But I do think we're going to start seeing more and more of this as institutions unleash it and allow people to start talking about it. January 9th, 2024, then SEC Chair Gary Gensler, who's no longer the SEC Chair, announced that Bitcoin exchange-traded funds were approved. Exchange-traded funds are just like mutual funds, but they trade during the day like stocks. This is a big deal because it makes it easier for institutions and corporations to acquire and custody Bitcoin. And it also makes it easier for individuals to get access to it through their brokerage accounts if they want to put it in, say, a tax-advantaged account like an IRA. So on January 11th, 2 days after that announcement, 11 spot ETFs began trading, most notably from BlackRock and Fidelity, the number 1 and the number 3 largest asset managers in the world. And as you can see in the chart there, BlackRock's ETF broke records, hitting $80 billion assets under management in the first 374 days. Now compare that to Vanguard's very popular S&P 500 fund, VOO, which took 1,814 days to do the same. So very, very popular products. This is a little bit outdated because obviously Bitcoin is now 80 billion under BlackRock's IBIT fund, but you can just see here the launch of their gold ETF versus the launch of their Bitcoin ETF and how popular it's been. Again, this is a picture of BlackRock's CEO, Larry Fink, the largest asset manager in the world, and I have a short clip of him talking about Bitcoin in July of 24.
I know you have been a leader in willing to embrace crypto. You have made it so that people can be in Bitcoin. We hear that you are thinking about Ethereum. These are incredible things. Now, BlackRock is not known as a gunslinger by any means, so you obviously must believe that this may be as an alternative. Is this an alternative in order to be able, because of a deficit, maybe something long-term people should have?
Absolutely. As you know, I was a skeptic.
Yes.
I was a proud skeptic. And I studied it, learned about it, and I came away saying, okay, my opinion 5 years ago was wrong. Here's my opinion today. This is what I believe in today. I believe the opportunity today. I believe Bitcoin is legitimate. I'm not trying to say there's not misuses like everything else, but it is a legitimate financial instrument that allows you to have maybe uncorrelated, non-correlated type of returns. I believe it is an instrument that you invest in when you're more frightened, though. It is an instrument when you believe that countries are debasing their currency by excess deficits, and some countries are. I believe we have countries where you're frightened of your everyday existence, and you have an opportunity to invest in something that is outside your country's control. Then you can have more financial control. And so I'm a major believer that there is a role for Bitcoin in portfolios. I believe you're going to see that as one of the asset classes that we all look at. I look at it as digital gold, as I said before, and I do believe there's a real need for everyone to look at it.
In December 2024, a new accounting standard, Accounting Standard Update 2023-08, went into effect. Why is this accounting standard important? Well, prior to this accounting standard, any company who purchased Bitcoin and held it on their balance sheet had to account for it as an intangible asset. And I know there's non-accountants on this webinar, but what is intangible asset accounting? That would be like if I bought Bitcoin for $100,000 and I had an asset on my balance sheet. If the price went to $50,000, I would have to write down the value of that asset to $50,000, which makes sense, and take a $50,000 loss through my income statement. However, if the price then subsequently went back up to $100,000 or even $200,000, I'm not allowed to write my asset back up to the fair value of Bitcoin. So it's very punitive accounting standard. So now that this has been changed, companies are going to recognize Bitcoin on their balance sheet at fair market value with gains and losses running through the income statement. As noted on a prior slide, businesses hold about 1 million Bitcoin, which is 5% of the total supply currently, and that's pretty evenly distributed between private and public companies. This slide shows a breakdown of some of the industries that have adopted Bitcoin on their balance sheet. Having worked in real estate and construction, I found it interesting that 10% of River's clients come from that industry. Here are some of the public companies that hold Bitcoin. Many of them are Bitcoin miners or exchanges, but we're starting to see more and more players come into the space. And I would anticipate even more so with the new fair value accounting rules. So companies that a lot of you would be aware of that are in the S&P 500 would be Tesla, holds Bitcoin, SpaceX is not in the S&P 500, but also connected with Tesla, Coinbase, and then Block, which owns Square and Cash App. That's Jack Dorsey, who created Twitter. Let's take MicroStrategy. I used them, I talked about Michael Saylor earlier on when I was talking about the skeptic's journey. Let's use them as an example. They're a software company that competes with Microsoft that's been writing the playbook for others to follow since. They started buying Bitcoin in 2020, and as of the end of 2024, had $14 billion of unrealized gains that, again, they weren't able to recognize under the old accounting standard, that they were then able to take through their income statement as a gain in Q1 of 2025. Now, as of July 2025, or as of actually through today, they hold 632,457 Bitcoin worth approximately $71 billion and an unrealized profit of $25 billion. This chart shows when they made those Bitcoin acquisitions, and you can see it wasn't just a one-time purchase. They're not buying at the top, not buying at the bottom. They're not trying to time the market. They're just buying as much Bitcoin as they possibly can. These are MicroStrategy's returns since adopting their Bitcoin strategy, 3,400% compared to NVIDIA and Tesla and Google and Microsoft and Apple and others that you can see here. In December 2024, MicroStrategy joined the NASDAQ 100. So if you hold any QQQ ETFs, you indirectly hold some Bitcoin exposure. There's also a lot of discussion around MicroStrategy getting inclusion into the S&P 500 because they met all of the necessary criteria as of June 30th, 2025. Side note that I think is a little bit interesting, Vanguard, who as an exchange does not currently let you buy Bitcoin, is the largest individual holder of MicroStrategy. They have 20 million shares, which is about 8% of MicroStrategy's total shares. Countries that own Bitcoin. The U.S. has the most Bitcoin of any country, with China being second. There is some speculation that some of that Bitcoin was sold under the Biden administration, but nothing has been confirmed so far. They're keeping that pretty quiet. Interestingly, at the very bottom there, you can see Germany. They had 50,000 Bitcoin, but they sold all 50,000 of those at an average price of 53,000 last year. In July of 2024, Senator Cynthia Lummis out of Wyoming put forth a Bitcoin reserve bill to the U.S. Senate, which she has just recently reintroduced. The bill mandates that the U.S. hold onto the Bitcoin that it currently has and doesn't sell it, but then also buys an additional 1 million Bitcoin, which again would be 5% of the total supply, over a 5-year period, and then hold that Bitcoin for at least 20 years. Without getting political, because to be frank, I don't really love politics, I think it's fair to say that the current presidential cabinet is overwhelmingly pro-digital assets. There's even a newly created position called the Crypto Czar, which is David Sachs, about halfway down on the screen there, whose entire role is to create clear legal framework for digital assets to operate under. And that started already to take shape with the Genius Act and the Clarity Act, which were passed just in July of 2025, if you saw those in the headlines. So obviously Donald Trump, he spoke at the Bitcoin conference 2 years ago. J.D. Vance spoke at the Bitcoin conference in Vegas this year. Scott Bessent, Treasury Secretary, has been known to own Bitcoin. Look up his thoughts on Bitcoin. Howard Lutnick is Secretary of Commerce. He's in charge of the tariffs. He came from Cantor Fitzgerald, which is an investment bank, and they have gone in and started a Bitcoin treasury company with some others. David Sachs, I already mentioned. Paul Atkins, the new SEC chair, is very pro-Bitcoin. Elon Musk, I've got the Doge team here, even though they're no longer together. Elon Musk obviously owns Bitcoin with Tesla. Vivek Ramaswamy spoke at the Bitcoin conference this year, going to run for Ohio governor, obviously. And his asset management company, Strive Asset Management, recently went public, and they changed the strategy to become a Bitcoin accumulation company. So the entire point of the company is to try and acquire as much Bitcoin as they possibly can. And then RFK Jr., also a huge advocate of Bitcoin, spoke at the Bitcoin conference 2 years ago when he was running for president. U.S. states that are considering Bitcoin strategic reserves. In the last 7 months, representatives from 26 different states have put forth strategic Bitcoin reserve bills at the state level. Remember, Senator Cynthia Lummis put one at the national level, but there are also states doing the same thing. 7 of those are still live, and 3 of them have already been enacted. So Texas, Arizona, and New Hampshire have a strategic reserve bill. In June of 2025, I had the privilege of providing testimony to the Ohio House Technology and Innovation Committee on House Bill 18, the Ohio Strategic Cryptocurrency Reserve Act. which is one of those 7 bills that is still live. House Bill 18 would allow Ohio to invest up to 10% of its rainy day fund in digital assets that have a market cap greater than $750 billion. Bitcoin, being a $2 trillion asset, is the only digital asset currently that fits that market cap. State pension funds are allocating a portion of their portfolio to Bitcoin. See Wisconsin, Florida, Michigan. And then as recent as a week or two ago, President Trump signed an executive order that is aimed at allowing citizens to hold crypto, which would obviously include Bitcoin, in their 401ks. In January 2025, the SEC repealed Staff Accounting Bulletin 121, which made it very, very difficult for banks to hold and custody Bitcoin. And so by repealing that with SAB 122, I believe that you're going to start seeing banks over the next 12, 24 months are going to start getting more involved in custody. In May of 2026, Steak and Shake began accepting Bitcoin. And they tweeted out that it's 50% cheaper for them than credit card fees. They're going to use the savings to improve food quality. I haven't been there since, so I can't speak to that. But thanks to the positive impact, they're going to start remodeling all their stores. Thanks, Bitcoiners. And then here's what it's going to look like. Bitcoin's marketing color is orange, so that's why it's like that. So why aren't we seeing more of this? Okay. First, I would say that Bitcoin is not currently legal tender in the US. And so every time you use it, if I wanted to buy a burger, in theory, I have to track how much did I pay for that Bitcoin versus what was the price of Bitcoin when I bought the burger, which is obviously an administrative hurdle. There is, however, a lot of positive momentum within the White House for de minimis tax exemptions, whereby if you spent under a certain amount, say $10,000 for the year, you wouldn't have to report capital gains on those purchases. Second, Bitcoin was designed to prioritize security and decentralization over speed. Final settlement in Bitcoin takes about 10 minutes, which we're going to talk about later when we talk more about the infrastructure. However, there are layer 2s that are being built on top of the Bitcoin layer 1 blockchain, which is what Steak and Shake is able to use to have people buy instantly at their restaurants. So there's something called the Lightning Network that makes it much faster to transact, that sits on top of the Bitcoin blockchain. So much like the internet, I think it's just going to take time for some of that development of layer 2 protocols to make it more and more usable. I personally believe you're going to see more and more companies, retailers start to accept Bitcoin in the near future. All right. CPA code word, it says 4, but this is number 2, is blockchain. As I said before, I think it's extremely important if you're going to understand Bitcoin to understand quickly a brief history of where it came from. The simplest way for humans to exchange value is to exchange valuable goods with one another, which is known as barter. Now, unfortunately, it's highly impractical in a more and more sophisticated and larger economies. So due to some of the issues noted in the slide, so like number 1, lack of double coincidence of once. What are the chances that I have apples and you have bananas and we just so happen to want to trade those at the same time? Or number 4 there, indivisibility of goods. I have a cow, you have grain. How do I divide up that cow to get an equal amount of grain? Monies ended up emerging because of these limitations. So, it sounds silly, but what is money? Money's a market good, just like a banana or a car are a market good. But the difference is you acquire a banana to consume it, to eat that banana. You acquire a car so that you can consume it. You can drive the car. You acquire money uniquely not to consume it. It's the one market good that you don't consume. You acquire it to save and exchange it later for the things that you need. It's a technology that developed over time. Jack Mallers, CEO of Stripe, says it's your time and energy in an abstracted form. Each of us go to work every day and we exchange our time and our energy for money so that in theory it can store value and we can use it later. If someone else can print that time and energy, it's the closest thing that we have to time travel. Throughout history, humans turned to all sorts of items as money, including on the island of Yap in the top left, they literally used giant stones called rye stones. You got tobacco bales, tea bricks, salt, glass beads, and cowrie shells. All of these forms of money eventually failed in comparison to gold because it had better monetary properties, such as durability, divisibility, fungibility, portability, verifiability, and scarcity. This is why gold has value, even though it's not backed by anything and doesn't produce cash flows, which are things I commonly hear about Bitcoin. So let's go through these real quick so you can understand. Durable. Gold is very durable. Try breaking a gold bar. Bitcoin is very durable. It's literally in cyberspace. Fiat currency, meaning like dollar bills, are not very durable. You can break them pretty easily. Divisibility. Gold is not very divisible. It's hard to shave off pieces of gold bars. Bitcoin is divisible by 100 million Satoshis, which again we can talk about later. So it's very divisible, and fiat currency is very divisible down to pennies. Or even if you're going to transact online, you can even go beyond that. Fungibility. How interchangeable are they? So a gold bar is a gold bar, not like a seashell where every seashell is slightly different. Bitcoin is very fungible. Every Bitcoin is the same. And fiat currency, in theory, is not very fungible because the US dollar is not the same as the Canadian dollar, not the same as the euro. Portability. Gold is not very portable, which is one of the main reasons it failed. It's hard to send gold from here to China and do it quickly. Bitcoin, you could send Bitcoin from here to China and it'll final settle in 10 minutes. Fiat currency, you can obviously send electronically. Verifiability, I would argue maybe against this chart and say that gold is verifiable if you're someone who really knows gold really well and have a magnifying glass. Bitcoin is very verifiable because it's on the Bitcoin blockchain. Fiat currency, there could be counterfeited. Scarcity, gold is very scarce. There's about 2 to 3% of new supply that comes onto the market every year from gold mining. Bitcoin is extremely scarce because there's only ever going to be 21 million. And fiat currency is not very scarce because, as we'll talk about more and more, it can be printed at will. Track record, gold has the best track record because it's been around thousands of years. Bitcoin is only 16 years old, and fiat currency has really only been around for the last 50 years. Importantly, there are also 3 primary functions of money, which are achieved by the characteristics of money that we just talked about. So all money starts as a store of value. And in order to be a store of value, you have to be scarce and you need to be durable. Once you have established being a store of value, you become a medium of exchange. In order to be a medium of exchange, you need to be acceptable and you need to be portable. And this is why gold is not used as a medium of exchange. Even though it's a store of value, it is not very portable. Lastly, you become a unit of account. So people start pricing things in you. So the dollar is a unit of account. We price things in dollars. In order to be a unit of account, you need to be divisible and fungible. I believe that Bitcoin has the monetary properties that were listed on the prior slide to fulfill all 3 of these over time. We just happen to be in the store of value phase. By the late 19th century, most currencies followed the gold standard, which meant that their currencies were pegged to gold and could be exchanged one for one. During World War I, which was 1915 to 1918, the European powers suspended the gold standard and then returned to it after the war so that they could print more money during the war. In the 1920s, 30s, and 40s, the U.S. accumulated by far the world's largest gold reserves as many European countries repaid their World War I debts with gold and also shipped gold to the U.S. for safekeeping during World War II. So you can see the sharp run up there in the chart of gold held by the U.S. The U.S. also, under Executive Order 6102 in 1933, that was FDR, Franklin Delano Roosevelt, issued that all U.S. citizens had to sell their gold to the U.S. government and confiscated all of it. So that's the point that the U.S. had the most gold in our history. In 1944, with World War II victory in sight, the Allies met in Bretton Woods, New Hampshire, to discuss what the new global monetary system would be. Now, given that the U.S. held 2/3 of all the world's gold reserves, countries agreed to fix their currencies to the U.S. dollars, and the U.S. fixed the U.S. dollars to gold. So It was an indirect way for all of those other countries in the world not to have to actually hold physical gold, but still be pegged to gold. Now that worked for a few decades. Eventually other countries lost faith that the US could actually convert the dollars to gold because of the Vietnam War and other social programs that were going on at the time. France literally sent a battleship not to fight us, but to come get their gold back. Portability. Under this pressure, August 15, 1971, U.S. President at the time, Richard Nixon, announced that the U.S. dollar would no longer be pegged to gold.
The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. The strength of...
So what did the U.S. do rather than lose its control at the center of the global monetary system? It found a way to force other countries to continue using dollars as the global reserve. How did they do that? And the answer is oil. This is the same chart before. I just wanted to show it again so you can see the sharp run-up and gold accumulation, and then it came down as other countries wanted their gold back, and then it stopped at the Bretton Woods Agreement when we said, okay, no more convertibility in 1971. 1974, Saudi Arabia agreed to sell its oil exclusively in U.S. dollars in exchange for U.S. guaranteeing their security in the region. Any excess dollars that they accumulated would typically be used to repurchase U.S. treasuries to earn interest. This chart shows the balance of trade since we went off the gold standard in 1971 and the dollar became the global reserve currency. This is what's known as the Triffin's dilemma that the U.S. faces. It has to run consistent trade deficits to supply enough of its currency to global markets. However, those same trade deficits weaken our own economy by fostering debt and eroding confidence in the currency over time. So, in summary, the U.S. is exporting dollars and we're importing manufactured goods. This has unfortunately hollowed out a lot of our manufacturing industry over the last 40 years. Countries like China don't necessarily want to be the reserve currency. They intentionally keep the value of their currency low. They keep the yuan weak so that their exports are more attractive. They have about $1 trillion trade surplus every year that instead of putting it back into their own investments and strengthening the yuan, they invest in the U.S. real estate and U.S. stock markets to make money. So this chart shows the global reserve currency going back to the 1500s. We've had the Spanish real, the Dutch guilder, the French livre, the pound sterling, and right now the U.S. dollar. All of those other former reserve currencies were backed by gold. So for the first time, we have a global reserve currency that is backed by nothing but its state power. And I would say it's yet to be seen whether we will return to a neutral reserve currency such as gold or Bitcoin in the future. This shows historical U.S. debt outstanding since the 1970s. So you can see that versus gross domestic product. This is the U.S. debt clock, which can be found online, or you could download the app for $5. As you can see in the top left corner, the U.S. national debt currently sits at around $37 trillion, and debt to GDP in that same box is 123%, whereas in 2000 it was 57%. In the top middle box, federal tax revenues are $5 trillion, and we spent $7 trillion just in the last 12 months. In the middle left, you can see largest budget items. It's a little bit small. The largest expenditures that the U.S. government has are Medicare and Medicaid, Social Security, defense, and interest on our debt, which just passed how much our defense budget is. All of those combined by themselves are greater than $5 trillion. So again, $5 trillion in tax revenues, and we're spending more than that just on our top 4 line items. Those are incredibly hard things to change because it's nearly political suicide to reduce any one of those entitlements. We're in a period, because of this, of what I would call fiscal dominance, when the government spending and our borrowing policies exert such a strong influence that it limits the effectiveness of the central bank's monetary policy in controlling inflation. So if you start on the left side of the circle here, you've got sustained inflationary pressure, prices are up. So what does the Federal Reserve do? They raise interest rates, they hike interest rates so that it slows down people from borrowing. That leads to higher interest expense on the government's own balance sheet because they have to pay higher interest on their debt, which leads to larger fiscal deficits. And so in order to cover those fiscal deficits, we print more money and we have quantitative easing, which then leads to more money in the system and sustained inflationary pressure, and you start all over. This chart shows cumulative inflation since 1913, again, when the Federal Reserve was created, and you can see what has happened since 1971 when we went off the gold standard. Code word 3, we've got inflation. Inflation. All right, this slide shows the currency debasement just over the past 10 years. So obviously we are not alone. The U.S. at about 46%. A lot of that, again, having to do with all the money that was printed since COVID. Chart hits home to me. Fast food inflation over the last 10 years. My kids always want to get McDonald's on Fridays, so I see that one. Inflation adjusted home prices. You can see where those have gone the past 134 years, but pay particular attention 1970, 1971. Now, that's great for those of us who already own a house, but a big problem for those that are just now entering the market, if you have younger kids. As can be seen in this chart, household incomes have just simply not kept up. So you've got about a 5x between the two. Now, why is this? Again, if you go back to the slide where I had there was $1,000 trillion of wealth in the world and everyone's looking for a place to put their money. Smart investors are looking for a place to store their wealth over time, and they're often buying second, third, fourth homes to do so. Homes are not being purchased purely for the utility value, but as an investment. Now, one important item I believe to call out is that there's a difference between the Consumer Price Index, CPI, that you often hear representing inflation in the news, and the M2 money supply. CPI is a hand-picked basket of goods that you're often going to hear, whereas the M2 supply is cash, checking deposits, and other deposits that are readily convertible to cash, like CDs. So it's the actual money supply in the system. So you can see the difference here in the chart of the growth of the two, and M2 money supply is typically much higher than CPI. Why does the U.S. print money instead of just raising taxes? That's a good question, right? Like we looked at that U.S. debt clock. Why not just raise taxes times 3? Well, raising taxes can be counterproductive because it takes money out of hands of those who could otherwise invest it and spend it, and then the government collects those taxes later. And it's much, much easier to just print money and increase inflation than it is to raise taxes. You saw the debasement chart of 46% over the last 10 years. If your taxes went up 46%, I think most of us on this webinar would probably be in the streets. People generally do not understand where inflation comes from, and it's easy to blame greedy corporations instead of the M2 money supply. Let's listen to famed economist Milton Friedman real quick.
As I said before, keep your eye on one thing and one thing only, how much government is spending. Because that's the true tax. Every budget is balanced. There is no such thing as an unbalanced federal budget. You're paying for it. If you're not paying for it through it in the form of explicit taxes, you're paying for it indirectly in the form of inflation or in the form of borrowing. The thing you should keep your eye on is what government spends. And the real problem is to hold down government spending.
As you can see in this chart, very few assets have been able to outperform monetary inflation over the past 14 years versus consumer inflation that we often use as a benchmark. No asset has had a higher correlation, historically, no guarantees again, with the M2 money supply than Bitcoin. To me, it's simple. If you believe the US is going to have to print money, then hard, scarce assets are going to go up, like the stock market, like real estate as well. But I believe Bitcoin is going to be one of the primary liquidity sponges over the next 5 to 10 years and beyond. This is perhaps the most important slide in this entire presentation to me. It shows the growth in the net worth of the top 1% over time. This is what's known as the Cantillon effect. Printing new money doesn't impact everyone the same way. It leads to a redistribution of purchasing power. If BlackRock can borrow at 2% and buy a bunch of homes, and the average American has to buy at 7 or 8% and buy a home, there's a big gap there. If you invest in hard assets like real estate and stocks, you're going to keep up with monetary inflation. So my guess is most of the people on this webinar are doing just fine. If you live paycheck to paycheck, you're in big, big trouble. I would venture to guess, again, that most of us are in or will be at some point in that top 1% or top 10%. Again, I believe that a lot of the divide we have in our country today is caused by the fact that our money is broken, but unfortunately it's easier to blame politics, race, and religion instead. Now, mine sound like I'm just talking bad about the U.S. I do believe the U.S. is the best country in the world. But imagine living in one of these other countries. These are their currencies compared to the U.S. dollar over the last 10 years. So imagine living in Venezuela, Syria, Argentina, Turkey, Suriname, and others, literally losing almost 100% of their value just against the U.S. dollar. The challenge for the citizens of all of these countries is that they don't have access to the U.S. equity markets. They're under authoritarian regime, and they also often don't have property rights as well. So where do they turn? This is one of the reasons that Alex Gladstein, who's the Chief Strategy Officer at the Human Rights Foundation, is such a big Bitcoin advocate, calling it recently the most important human rights technology of the 21st century. Okay. Finally, we've got 12 minutes left and we're getting into the advent of Bitcoin. Bitcoin was birthed out of 40 years of R&D. It didn't just come out of nowhere. It took a lot of work on peer-to-peer networks, smart contracts, proof of work, digital cash, until we actually got to the point that Bitcoin was released. And Bitcoin was released in 2008, coming out of the financial crisis. So on the left side of your screen, that is an article from the Times out in the UK, I believe. Chancellor on brink of second bailout for banks. On the right is Bitcoin's Genesis block, so the first block in the blockchain. And written into the source code of the software is that same article's title. Okay, October 31st, Halloween of 2008, is when the Bitcoin white paper, which is intended to describe the original plan and protocol for Bitcoin, was released under the pseudonym Satoshi Nakamoto. The identity of Satoshi is unknown still to this day, but many people believe it was a group of people as opposed to one person. To me, it's not important who Satoshi is because he can't come back and change it. It's completely open source protocol. It's rules with no ruler. The white paper is only 9 pages long. It's available online if you guys want to look at it after this. We're going to spend the next couple slides picking this paragraph that you see ahead of you apart. So it begins. A purely peer-to-peer version of electronic cash would allow online payments to be sent directly from one party to another without going through a financial institution. So what is peer-to-peer? Okay, peer-to-peer is a networking term, meaning that there's no central server. So if you look at the left side of the screen, that is what we're used to. That is a server-based network. You send an email and it goes through Google before it reaches its end destination. You send money and it goes through your bank before it reaches its end destination. Peer-to-peer networks remove centralization, which is why you may have heard that Bitcoin network is decentralized. Bitcoin has no CEO, no governing authority, no lobbyist, no central attack point. Everyone is just interacting with each other. Okay, the white paper goes on to say, we propose a solution to the double spending problem using a peer-to-peer network. So it'd be important to know what is the double spending problem. In a peer-to-peer network, when you don't have a centralized authority in the middle of the network, how do you know that someone who sent you money didn't also at the exact same time send that same money to somebody else and they don't actually have the money to send to you? The Byzantine generals problem is a game theory problem in computer science that existed for a long time, and it describes how difficult it is for dispersed parties to reach a consensus without the help of a central party. So if you're looking at this on the left, again, the game theory here is that there's a bunch of generals surrounding Byzantine, and if they all attack at the same time, they'll win. If they're not coordinated and one or two of them are traitors and leave, then they'll lose. So how can they organize to attack at the same time? With regard to money, Bitcoin was the first ever realized solution to the Byzantine generals problem. And how did it do that? Well, it does it with the Bitcoin blockchain, which is a completely public, distributed ledger that stores a history of every single transaction to do so. So for the accountants that are on the webinar with me, imagine a Google Sheets or an Excel workbook that every single person that has money has access to, and every single transaction is in there, and you all have access to the same book. Okay, let's talk about the Bitcoin blockchain quick. The network timestamps transactions by hashing them into an ongoing chain of hash-based proof of work. If you've never studied Bitcoin, that sentence likely makes little to no sense to you, so let's look at the steps of a blockchain transaction together. High level here, right? A user, so someone wants to send money, they request a transaction, and it goes to a computer called a node, which is going to verify that that person has not also spent the money somewhere else, double spending. That then gets added to a block of data of other transactions, and that node, that computer, distributes that block out to all the other nodes on the network. All of the other nodes, computers on the network, add it to their blockchain, and the transaction's complete. Let's look at each one of those a little closer to understand it. So first, a little bit about nodes. Nodes, again, are just computers. They're all over the world, and they help to secure and mine Bitcoin. Why would you want to be a node to begin with? First of all, if you want to mine Bitcoin, which we'll talk about the advantages of that, you need to be a node, and you need to have every single transaction that was ever recorded on the blockchain. Other people run nodes just as a way to voluntarily contribute to the development and the security and the integrity of the blockchain. All right, the very first step is you want to send money, you sign off on a transaction from your wallet application attempting to send it to someone else. On the left side of the screen, that's something called a hot wallet that's very similar to like Venmo. You just have an app on your phone to send it. The other picture is an example of a cold wallet. That is more secure, but less easy to send money back and forth. You have to plug it into your computer every time you want to send money. But in theory, no one can hack into it because it's completely offline. So you decide you want to send money. You need to first go to your wallet to send it. You tell the network that you want to send money, and it goes into a pool of transactions. And it just sits out there until miners decide to pick your transaction up. What is a miner? I promised I would talk about this. The simplest way to describe what a miner is that they just verify the transactions on the blockchain. Okay, so today, most mining is performed by mining companies. So the picture on the left is from probably a large public mining company that just has a bunch of hard drives lined up together. But you could also, I just threw a picture up here from Amazon yesterday, the low cost of $109, you could buy your own Bitcoin mining machine that's literally just a hard drive to try and mine Bitcoin yourself as well. Okay, last code word is mining.
Just wanted to let everyone know it looks like we had a switch up in the code word slide. So if you guys all just want to choose money as the answer here, that was fine, and you guys will get your CPE credit regardless.
So why do miners spend their time and their energy verifying transactions? First of all, they get transaction fees for doing so, and they also get mining rewards. This is how Satoshi decided that he was going to distribute Bitcoin to everybody. The reward for mining a Bitcoin block was originally 50 Bitcoin back in 2009, but that reward gets halved every 210,000 blocks, which is typically about every 4 years. The current reward, as you can see there, is 3.125 Bitcoin. So literally for every block that is mined, I told you the price was 112,000, you would multiply 3.125 times 112,000. There's only ever going to be 21 million Bitcoin in existence, and all Bitcoin will be mined by the year 2140. This just gives you a glimpse as to where we're at in the Bitcoin halving, so we're still very early in those. Now, again, compare this to the supply curve of other modern reserve currencies. Bitcoin has a very intentional logarithmic deflationary chart. In the first half of 2025, 545,579 Bitcoin were purchased by public companies and ETFs. For comparison, for all of 2025, there will only be 164,250 Bitcoin mined. And that's going to be cut in half in 2028. Okay. Miners select transactions from the pool and form them into a block. Every miner constructs their own block of transactions. Multiple miners can select the same transactions in their block. Okay, so again, a transaction gets sent, it sits out in a pool. Miners are going to start picking out transactions from that pool, likely based on how much transaction fees there are, and they form them into a block. A block can only be 1 megabyte. Okay, so they don't just continue putting transactions in their block forever. Once they hit 1 megabyte, they're done. Before adding those transactions to their block, they make sure that that participant did not double spend their money. Because again, they have access to every transaction that ever took place on the blockchain. To add their block as a miner to the transaction, to add their transactions which are in the block to the blockchain, every miner has to solve a complex mathematical problem. And that's why it takes a lot of energy and computational power. And that's why a lot of people aren't doing it individually on their own laptops. That's why a lot of public companies are doing it, because it takes so much energy. But that's also what keeps people from spamming the network and having a bunch of transactions in there that are not good transactions. So this is the process that is referred to as mining. Miners are going through and solving complex mathematical problems to determine who's going to get to collect the reward. Once they actually find an eligible, they solve the problem that they were trying to solve, they broadcast it to all of the other computers around the world. The other miners verified that that was a legitimate, that they actually did. So think of it like a Rubik's Cube. When you're trying to figure out a Rubik's Cube, it takes a long time. But once you actually solve the Rubik's Cube, you can hold it up and show everybody, and it's very obvious to tell that you solved it. So it's hard to solve, easy to verify. That's how the blockchain works. The miner that solves the equation first broadcasts it to the rest of the network, and everyone else says, yep, you got it, and they start mining the next block. That happens every 10 minutes on average. Okay, almost done, I promise. So now that we've added a new block to the chain, let's see what it says next. He says, forming a record that cannot be changed without redoing the proof of work. This is important. So in order to get control of the Bitcoin blockchain, you'd have to get 51% control of the computing power. Now that might have been easy to do in 2009 or 2010 or 2011, but at Bitcoin's current size, how many nodes there are around the world, no government, no Google, no Apple could get together and hack Bitcoin. So this shows even if you were able to get 51% control, the attack cost on the Bitcoin blockchain is about $2.2 million for every hour that you were in there. And since a block is added to the blockchain every 10 minutes, that would be 6 blocks an hour that you would, in theory, be able to attack. There have been 911,000 Bitcoin blocks that have been mined since the Genesis block. And if you were going to actually hack the system, you have to be able to hack all the way back to the Genesis block, because in Bitcoin, the longest chain wins, and all of the other Bitcoin blockchains, all the other computers will override your fake one. Okay, this is the very last slide that I have in here. I typically like to read it. It takes a couple of minutes. I'm not going to read it since we just hit our time. I just think it's a really good summary that Satoshi posted about 4 months after he released the Bitcoin white paper, and it kind of summarizes a lot of what we talked about. We are going to provide the slides after this, so you're welcome to read through it on that, re-listen to it, because this was recorded. So again, I really appreciate everyone's time today. I know there's likely still a lot of people who are skeptical, and that's okay. It's all part of the journey, and I just really appreciate everyone taking the time today to listen in. So thank you, and also get back to you on any questions that you guys have. Have a good day.